Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. In case you didn't notice, and it is hard to notice, the AI trade has crashed. And I know I've been complaining about technology stocks in the form of the indices having cracked, being in downtrends, and a lot of AI related stocks showing these rounded tops. So that I've been pointing out the patterns of topping out. But what we have now is an all out crash. And how do you know? Because we had a big climax moment in the middle of the week. We had a big plunge to the downside. And only after that plunge did we find out a likely cause, which is a hedge fund or a big money fund called Situational Awareness had been forced to liquidate and sell. And in fact, apparently they've been selling their AI concentrated portfolio for the entire month. They were short software stocks and had to unwind those shorts, which explains the rally in software stocks and the big plunge on Wednesday. And we're wondering what the heck just happened. Maybe it was the Fed. You know, we had the Fed meeting and people were very displeased about that. And the bond market has been soaring, soaring, soaring. So it makes high growth, low profit stocks more and more expensive the higher bond yields go. Turns out, I think it was that night, or maybe no, first thing Thursday morning, we found out about this situational awareness fund. Soon after that, revelation, Citadel magically shows up on the scene to buy up assets from this fund. This has all the makings of a crash, a big fund that was heavily concentrated in one of the hottest parts of the market, collapsed. That is the definition of a crash, but it's also possibly the definition of the end of that crash. It's not necessarily true because who knows how many other funds are out there that have over-leveraged themselves. And it's very telling, right? Situational awareness reportedly was up 400% in the first half of the year. And then even after their portfolio crashed, they're still up 80% for the year. And this is why a lot of people may not notice that the AI trade has crashed. A lot of these stocks are down 30, 40, 50% and more from their all-time highs and are still up significantly for the year. All right, so enough with that. We know that the market overall absorbed the pressure, absorbed the pain of the AI crash. The indices, the major indices ended up higher for the week despite the crash. The VIX ended up lower at the end of the week. In fact, it's in bullish territory. Market breadth held firm, held its support level around that 49, 50% level. You'll see in the chart soon. And it's still in that churning pattern that makes me reassured not to get overly concerned about the pain in any one sector of the market. And we still have the war against Iran expanding, accelerating, escalating, however you want to call it. But we keep hearing about negotiations and they never happen. And all we hear about is more and more destruction and pain and war. And the market, once again, is becoming less and less sensitive to that, even less sensitive to the higher oil prices that are happening as a result of the expanding war. And I'm sure I forgot some other catalysts. Oh, of course, earnings. We had a lot of earnings news last week. Thus, I'm going to show a lot of stocks because I think a lot of these stories are very important. But the biggest highlight was in big cap tech. Apple crashed. Meta crashed. And I'm being a little, I'm pushing the description a little bit, but they fell significantly, 10% before rebounding a little bit intraday. And then Amazon soared, I think 14%. And we had Microsoft soar 14, 16% or whatever. Biggest one-day gain in market cap in history. And this follows Google last week not collapsing, but selling off hard. And it's been in big time recovery mode. So it was like a seesaw. And overall, with the market net positive, that means that at the end of the day, this was all kind of a wash. We don't really have a resolution. And the AI trade, particularly in the semis, yes, it may have bottomed short term, but we don't know yet whether this is the bottom. So we haven't resolved anything quite yet, and we need to see more time unfold. Coming up this current week, I think the biggest thing I'm looking out for is the jobs report and how the market reacts to that. All right, let's dive into those charts, and I'm going to have to go as fast as I can. This is my favorite technical indicator, the percent of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. Basic message, still churning in place. Support here at the 49-50% level, still holding. In fact, we had another picture perfect test. Not so picture perfect, but you could see market breadth drop below and then, rallied back and closed higher, 51.67%. Pretty good. So I'm not worried yet about the overall market. Okay. Percent of stocks trading above their 200-day moving average. Same basic story, churning in place. And it's not quite holding, but it's pivoting around this level that I've identified for quite some time. It's around 56.2%. Closed the week right at that level, 56.1%. So on the long-term basis, short-term basis, I'm not worried about market breadth. Let's take a look at the indices, the S&P 500. This was fascinating, right? On the Fed day on Wednesday, it dropped 1.5%, plunged well below the lower Bollinger Band. Again, remember this, that black line there, this lower and the upper together define about 95% of expected price movement in a day, and it extended well below that. So we had an outlier event, and buyers do what they do when the major indices overextend themselves. They bought in. In fact, bought in so much that the S&P 500 gapped higher yesterday, and that was the signal that the bottom is in, perhaps for the week. I mean, it's quite a light night and day kind of reaction, because we came out of Wednesday thinking that this big drop was because of the displeasure of the Fed and that bond yields were rising. But no, it seems like really most of this was the final climax and climactic meltdown of a major fund that was overly concentrated, overly leveraged for AI stocks and against software stocks. And so the SP 500, as you can see here, actually, let me just make sure it's clear what I'm talking about. So here's the big plunge. This was the gap higher. And then we closed the week with the S&P 500 up on Friday, 0.7%, up for the week, above the 50-day moving average. In fact, let me just zoom in there so you can see it. 50-day moving average is that red line. So it closed above that, but guess what happened? That 7,500 wall came into play. It's not quite, I have this resistance drawn here. I mean, just magically, this is again why I love technicals. The S&P 500 tapped that support slash resistance slash pivot line that I've been talking about for quite some time and faded back. So while the market absorbed this AI related crash, we didn't resolve anything. So we're still in the middle of churn, still in the middle of this. Now what's extended into a two plus month trading range. Now the NASDAQ also, it absorbed the AI crash, but it too did not resolve anything because it is still in a downtrend. It is still in a bearish breakdown. Let me take you through it. We started the week here on Monday with a fade essentially from this old downtrend line. That's the purple line there. And then here's the big down day on Wednesday. The NASDAQ dropped 1.7%. I thought it was on track despite it being overextended for, actually you could see this. Look, the NASDAQ was falling along the lower Bollinger Band for 5 straight trading days. So this really looks like, and again, let me just make sure you're seeing what I'm seeing. It looks like a major climactic downward move. Even so, I thought that the index might be poised to very quickly test the 200-day moving average, which is this blue line, converging with what was a double top at former all-time highs from, stretching from the fall of 2026 into the winter. The fall of 2025 into the winter of 2026. So anyway, instead, like I said, what buyers do, and in fact, this gap up for the NASDAQ was even more powerful than the S&P 500. You could see that it gapped up so strongly, it opened right where it opened the previous day on the big loss day. That is a massive, massive move. And that means all these people who panicked and sold on Wednesday got trapped. We call that trapped, in this case, trapped sellers. And then what you end up getting is either shorts got trapped and they start rushing to cover, or people who sold things are now rushing to get right back in, and you create this feedback, reinforced loop. People buying on Thursday, so the NASDAQ soared 2.8% on Thursday and then gapped higher again on Friday for a 1% gain. So overall, the NASDAQ ended up positive. But you can see here that this old downtrend line is still in effect. And now the 20-day moving average, which is this dashed line, and the 50-day moving average are pointing downward, which means the NASDAQ has a lot of overhead resistance, a lot of overhang that it's got to overcome before I can consider it out of this bearish pattern. Also, IWM, the ETF of small caps, didn't quite resolve anything either. It has now developed this short-term downtrend represented by this purple line that I've drawn. It now aligns with a downtrending 20-day moving average. And you can see here there's a very tight range that the IWM has been trading in. And that means that, and actually, let me change this. So that means here that there is this trading range that's developed and nothing's been resolved, right? A lot of churn and it's pivoting around the 50-day moving average. That's all we can say. We're waiting for a breakout or a breakdown below this previous double top line, okay? So that's the story. Now let's look at the VIX. The VIX, interestingly enough, it collapsed on Thursday. I was earlier saying that I thought the VIX was poised for a pop, and it did. It popped on the Fed day. It popped what we now know as what's called a situational awareness collapse day. And then gap down for the VIX, plunged, absolutely plunged 17% on Thursday, and then dropped below this important line that's now become a pivot, which is the pre-tariff low from 2025, okay? So the VIX, once again, is showing complacency, but it is confirming overall bullishness in the market. All right, let's now jump into the stocks and the indices. So let's go really quickly. Have to show, of course, the ETF SMH, VanEck Semiconductor ETF. This is the big down day. SMH plunged 4.8%. You can see how far down it went. And then the next day, massive gap up. Again, this is what we would expect if forced selling ends. It creates a vacuum, and the prices at which the forced selling was happened are not the prices that the market in general agrees with. We get the huge gap up. Now, interestingly, and this is why I said that yes, this looks like a bottom, but we haven't quite resolved everything, is that on Friday, SMH did gap up again, but it spent the rest of the day fading so much it practically closed flat on Friday. So now we have these bookends: plunge on Wednesday, fade on Friday. These are bookends that tells me that we need to get either a breakout above the intraday of that open on Friday to confirm an ongoing rally, or we need to get a close below the low of the week to confirm the bearishness. Anything in between there is just going to be a lot of chop, a lot of churn, and no signal. So we have not resolved, not we, but the market has not resolved its sentiment on SMH. Overall, it is still in a downtrend as defined by the 20-day moving average. The 50-day moving average is starting to turn down. And then there's this old primary downtrend that I drew way back when that's still well in place, okay? Let's take a look at NVIDIA. NVIDIA is interesting. It also plunged below the 200-day moving average right here, and then it rallied up. So the buyers saved NVIDIA from a bearish breakdown on the 200-day moving average. So that's pretty good for NVIDIA. But again, nothing's really resolved because it's still in this trading range that's been in place since, let's call it, since April. Okay, so NVIDIA just chopping around. We have another semiconductor, AMD, Advanced Micro Devices. Check this out. It too, of course, fell well below its lower Bollinger Band, gapped higher, and its fade on Friday was so strong, it actually closed down for the day, 1.9%. And what's more ominous about the move on AMD is that it faded right from here, the 50-day moving average resistance, okay? What's probably going to resolve things for AMD is earnings are coming up this week. I will be on point to watch that one, okay? And another AI trade, Corning, ticker symbol GLW. It got saved. I really wanted to buy this one. I'm a big fan of Corning, as some of you know. Let's see if I can get a good view on this for you. Let's go right there. Post earnings, it fell. Oh, sorry about this. It fell Yeah, it fell below the 200-day moving average. It lost a whopping 12%. After the next day, some more weakness on that Fed day and situational awareness collapse day. It had some more weakness, but then from there, the buyers gapped higher, just like all the other AI trades, AI related trades, and then it gapped higher again, but it survived the 200-day moving average. In fact, it didn't quite test it. So I was so close to buying it, but I would prefer to see it test that line and then bounce off of that. So, but still, ticker symbol GLW, definitely on my buying list in the coming week. Now, let's talk about I think I have two more AI related plays. Hang in there with me. Vertiv Holdings, ticker symbol VRT, massive down day on Wednesday. I think this was accentuated because of, again, the dual catalyst of the Fed and situational awareness. Fell 17.3%, totally shocking to me. I decided to go ahead and sell a put. I think it was a 215 strike, and that worked out well. So this is one of the few places where I went ahead and went after what I saw as a well overdone move. Notice that Vertiv is not out of the woods, not even close yet, because its rally stopped cold right here at 200-day moving average resistance. So it is still in bearish mode, but Vertiv is on my list, my watch list for this coming week. And as readers and watchers know, I'm a long-term fan of Vertiv, but I did take profits earlier, and now the stock, I think, is below where I sold it. Remember, what I was really concerned about was this news of it being added to the S&P 500 and it following into the pattern of a lot of other stocks where that is the beginning of the end of a move for the stock, and that seems to be what's unfolding finally for Vertiv. And let's see, do I have another one? Yes, let's talk about AMAT. Oh gosh, AMAT, Applied Materials Cycle symbol AMAT. This is one of my favorite semiconductor equipment stocks, and you can see here it collapsed 8.4%, well below the lower Bollinger Band. Technically, I really should have gone after this one, but I just didn't. Oh, actually, I had a lot of other stuff I was trading and doing that day, not to mention just watching the Fed. And at that time, of course, I was mistakenly thinking that all of this was about the Fed. Anyway, massive gap up the next day, 15%. So sorry I missed that move. I would have loved to at least done, a similar trade to what I did with Vertiv, but just like others in this space, nothing was resolved. Yes, the market absorbed the collapse, but look at this. AMAT's fade came right below its 50-day moving average resistance. And so it is still in bearish territory. All right, let's see. Let's go on to the big cap tech stocks. All right, this is Apple, ticker symbol AAPL, fell 7.4%. Post earnings, it was down at about 9 to 10% at its lows, but again, look, overextended below the lower Bollinger Band. Buyers didn't wait till the next day and said they took Apple right up to, guess what? 50-day moving average resistance. So it has yet to prove the recovery is intact. I will be watching it like a hawk in this coming week. Now, the other big cap tech stock, and by the way, I think Apple lost about $350 billion in that one day. Meta is interesting because it too dropped a lot on its earnings on Thursday. Post earnings on Thursday dropped 8%. It was down worse than that at one point. And then the very next day, it gapped higher and stayed higher. It rallied 3.3%. But look, nothing's resolved. Meta is still in this large. Actually, let me just move these captions away. Look at that massive, massive trading range. It hasn't gone anywhere since the 2 years ago summer. So nothing's resolved. Meta is just thrashing and flipping and flopping about. Okay. Now on the positive side, we had Amazon, ticker symbol AMZN, surged 15%, but it's well above its upper Bollinger Band. It stopped short of the all-time high. Now, typically I say right after earnings, buying Amazon at any point will be profitable in the coming 2 weeks. I think the big opportunity was actually here at the open. I am not going to chase this. It's well overextended. I'm not going to trust the Amazon post-earnings trading rule in this scenario. The other positive big cap tech stock for the week was Microsoft. This was the one I really enjoyed because I've been talking about Microsoft a lot. I've got a big position. This is ticker symbol MSFT. It soared. Let me just draw so you can see very quickly. It soared 15.5% post earnings, and despite fading from its intraday high, it resumed. The buyers picked right up the very next day, gained another 3%. It now has confirmed the breakout above this 200-day moving average. Microsoft had the largest single-day market cap gain in history at $450 billion. And, basically, let's just call it half a trillion. That's just absolutely astounding. But to me, of course, Microsoft never should have been as low as it was in the first place. Now, notice Microsoft still has a ways to go to get back to its all-time high. But I hazard to say Microsoft has finally seen its lowest point where it was at earlier this year. Now, let's review this, okay? So Amazon soared because people are confident in the ROI on its AI-related investments. Same thing with Microsoft, but people are worried about Meta dropping its cash flow rate. Its cash flow. I think it's almost that free cash flow is almost going negative in terms of the trend it's on. And people are not confident that Meta is going to see the return on its AI investments. And then Apple just fell. I think people were just looking for a reason to sell. The stock had rallied sharply into earnings, and it was a little overdone. It was hard to understand why. In fact, let's just go back to the chart just so I can visualize it. It was kind of hard to understand how market sentiment flipped so hard and so fast from being worried about the price increases on the Macs and MacBooks and iPads because of memory and storage costs to suddenly saying, oh, I really must have Apple. And it just soared nearly straight up that entire time. In other words, it was overdue for this pullback, really got ahead of itself, but now it's in a somewhat of a bearish short-term position. So we'll see what happens with that. All right, now let's take a step back. I talked about interest rates soaring. Let's review what that means. Okay, this is TLT, the iShares 20 plus year Treasury Bond ETF. It's like a proxy for long-term bonds. Let's just be clear. It has been in a long-term downtrend since the pandemic. That means interest rates have been trending higher, and recently they have surged higher. Okay, and in particular, there was that response after the Fed meeting. This is what also a lot of us thought spooked stocks until we heard about the situational awareness. But look at this: the stock market at some point tried to ignore this increase in yields. Let's just be very clear where this is. Again, prices go down, yields go up. And then look at this. On Friday, the sell-off in bonds resumed, and did stocks care? Barely. That explains, of course, why IWM was negative on Friday, but the S&P 500 and particularly the NASDAQ just jumped higher, okay? I anticipate that the market will look around and see that yields, TLT here hasn't been this low in over 20 years. And I think this is going to become a problem if the trend continues lower, meaning higher yields. Let's also take a look at the other thing that I think the market's ignoring, which is the strengthening in the yen. The Bank of Japan intervened to strengthen the yen. This is a huge move in currency land. Trust me, this was 2.4% on Thursday and another drop of 1.3%. Both are huge moves for currencies. And the Bank of Japan looks serious because usually these interventions, they last a day, and then the buyers step in mechanically and just, take advantage of the largesse of the central bank. But it looks like they intervened twice, and now the pressure is going to be on the Bank of Japan to finally increase rates again. What does this all mean? We don't know how big the carry trade is. The carry trade meaning selling Japanese bonds, cheap bonds, because the rates have been negative and near zero for so long. Sell bonds to buy higher risk assets. That's called the carry trade. You're carrying actually, I don't know what the metaphor is. Oh, right. Well, you're carrying a loan, right, in one currency into another. Anyway, the point is that we don't know how big the carry trade is, but to the extent it does have size, the people who are going to be forced to sell because they've over leveraged on this carry trade are going to cause problems in the rest of the stock market. We just don't know where, but we can have a good guess. Probably in the last year or two, a lot of people who do this thing have been selling Japanese yen to buy AI related stocks. So that's the thing to watch out for. Is the yen going to continue to strengthen? And right now, I bet against it successfully once, twice, and then I overextended myself a third time. So I'm actually on my third bet against the yen because I'm trying to play these big bounces. And this last time I got caught in the second wind downward. So we'll see what happens in the coming week. All right. So remember, you got to keep track of this, even if you're a stock trader or investor. The bond market, number one. Currency market, number two. In fact, if you just pay attention to the bond market, I bet you that will be plenty. All right, let's close this out with with one more big cap tech. Google, just wanted to point out that it had a massive recovery. It stopped short, though, at the 50-day moving average resistance. But of course, I'm relieved at this because Google is now a big position of mine. I've been accumulating the stock. It's also amazing to see this massive change, right, in sentiment. Google gapped down 6.9%. And then suddenly people decide, oh, actually, Google's a great deal. And now it's much higher than it was even right before earnings. Go figure. I also want to make sure I show some of the big disasters I got caught up in. Roblox, ticker symbol RBLX, plunged a nasty 27, let's call it 26.9% on Friday. It's down now. I think it hasn't traded this low, since what is this, 2024. Big bubble in this stock. You could see how this was basically it's now double topped. So this stock, I call this a broken stock. It's pretty much done. It's only good for short-term trades. I did get caught up in this. I haven't quite decided what to do, whether to just bail and leave it for good. I'll just remind you, I was talking about how it looked very constructive in this area, so I dare to hold on to my position going into earnings. So I really hate getting caught by earnings. Anyway, same thing kind of happened with Reddit, ticker symbol RDDT. It plunged 21%. I'm a lot more optimistic about Reddit eventually recovering because I think this is a big overreaction by people looking at user growth numbers, but Reddit's profit-making and revenue-making engines are very strong. The CEO tried to emphasize that what's happened is they've lost some low-quality searches from Google, but they've increased the monetization of their high-quality users. That, to me, is a good thing, and they've got more people in the app than going on the web. The web is more dependent upon that search traffic. Anyway, I like the way Reddit kind of slowed down right here at the May low. And once I see Reddit get above its intraday high, post-earnings high, say about 151, I'm probably going to add some shares. So I am not abandoning Reddit. Unlike with Roblox, I could be very ready to abandon that. And then we have XLF. I just need to show the financials. If you looked at financials, you wouldn't know much happened. XLF, this is the State Street Financial Select Sector SPDR ETF. It fell 1.6% on Fed Day, and it's kind of hanging in there, but it's right off its all-time high. Financials are doing just fine and just great. One last one I want to show is trucking. Let's do something totally different here. Oh, there's actually this one and one more. Sorry. So this is C.H. Robinson Worldwide Trucking Logistics, ticker symbol CHRW. It I didn't really appreciate this verdict, the legal troubles that this company has been in, but it fell 15.4% post earnings. Apparently, there's a lot of consternation and uncertainty about some legal proceedings that the company apparently lost. All that to say, and I have some other captions here talking about some other legal troubles, is that the company quickly went from breaking out to an all-time high to now breaking down below this support level that I drew, which is the post-October earnings closing low. I'm keeping my eye on this because I still think overall panic in the stock needs to be bought. I've traded it successfully so far, and now I'm just going to be waiting for a positive sign. That sign almost came on Friday when the stock recovered from what looked like the next phase of a free fall. And the last one I want to point out to you is retail. A stock like Best Buy. This is ticker symbol BBY. On Fed Day, Best Buy was actually up, surprisingly enough. And when I saw this, I couldn't believe my eyes. It was up 0.8%, a new multi-month high. Let's just take a look. It hadn't been that high since early 2025. So let's just call it an 18-month high. It has fallen back, but you can see it's been on this great uptrend. This post earnings, 15.8% post earnings move back here in May, the momentum is essentially continued. Look at that, just continuing. So even though Best Buy overall is in this large trading range, I am now very curious to know whether, as I say, something is up, something's cooking, something's going good with Best Buy. Well, so it's back on my radar now. I want to take a closer look at this one. All right, this is only a fraction of the stocks I actually wanted to cover. I wrote about more stocks in my blog at drduru.com/122. If you want to check that out, that will be posted by Sunday on August 2nd. Otherwise, thanks for checking out this video. Subscribe if you want more. As always, put feedback and comments down below. I'm always happy to answer them. And please like and share this content so that the algorithm knows it's up and I continue to be motivated to create this content. This is Dr. Duru from Aha Analytics. Thanks again for checking me out, and I will see you the next time.